Okay guys, very good morning. Let's get right on with the briefing for this morning and digest the main kind of event, which was last night, of course, was the FOMC minutes. Charts I'm showing with you at the moment, we've got the boom top left, the DAX bottom left, and gold prices. So just take a look at the current state of play this morning, following on from what has been overall interpreted as a slightly actually dovish minutes. That meaning then, as per the more usual monetary policy way that the market's been moving, both the Bund and the DAX trading in positive territory this morning, albeit DAX has been held back somewhat by that pivot level. Gold also in positive territory. So when, one of the things that I do when I first sit down, when I come in and turn on my screens, is I look at the charts before I even look at the news, because the charts pretty much tell me the story of what's happened. So without anyone even telling me what the situation was from last night, I look at the Bund higher, I look at the DAX higher, and I look at gold prices up around $8.50, and I already know that means then it's been interpreted as dovish in terms of reaction. The charts will tell you almost what the news is gonna spell out when you start going through it. Going back then, let's break down exactly what happened. And I'm changing these charts here to the actual release time. So let me just highlight it more closely so you can see what I'm talking about. So the area which I'm going to measure up here is the actual 7 o'clock release. These are minute candlesticks, so we can see how the market initially interpreted the news. So you can see here in both the Treasury, the T-note, and the E-mini S&P, we initially blipped lower in both products before then rallying. And that's because, I'm sure you've read the newspapers and your research notes this morning, it wasn't an overtly dovish report. If anything, it was more slightly mixed. The board being divided was kind of the main headline reading. But what I've done is I've quickly, you have to excuse my paint skills this morning, copy and pasting. But what I've done is I've gone through Twitter to find basically the headlines as they came out last night, because I think this is the best way to decipher and learn from how to read and understand the minutes. And first of all, I've broken them down into hawkish and dovish. So these were all comments that were run on the major news wires. This is a guy on Twitter, Walter Bloomberg, handle @Delta1. If you do not follow him, then follow him as of after this briefing, because he's excellent at posting some of the main headlines that come out. So as I've divided this then, you can see why the market, in my opinion, reacted to start with more hawkishly, i.e. rates being lifted by the Fed sooner rather than later, i.e. September definitely being live. That being some of these main comments here, that uncertainty from the Brexit and May hiring slowdown has receded. Some saw another rate hike appropriate soon. Most saw US at or approaching full employment, and some voters see another hike soon warranted. The split Fed in July sought to keep options open on a rate hike. It's hard to argue that those comments aren't hawkish. The only problem is that in the mix were comments such as general agreement to accumulate more data before rate move. Now, that's quite important, because if you think about it, these minutes are historical. And if you think about the economic data we've had from the US more recently, if anything, it's been worse than expected. You've had slower growth. Q2 GDP in the US was 1.2%, below the expected 2.6%. You've had weak retail sales at the end of last week. You've had lower than expected inflation. And if the Fed 2 weeks ago, when they held their meeting, was saying that there's an agreement generally to accumulate more data, well, that data's told you that there should not be any rate hike if they're looking at those economic indicators that were coming in. And hence then, I feel the reaction ultimately started to move more in toward the minutes after. Treasury bid was fairly firm. Equities also started to rise as markets discounted September and pushed back rate hike expectations once more. Looking at gold, you can imagine what the gold move was like. Again, blip low was the first reaction, but then a spiked up, came back, and then we saw a rally of approximately $10 before finding a bit of resistance near to R1. The other comments as well that made it a little bit more, let's say, dovish than maybe some may have expected were some of the other comments about external. So European banks under pressure, particularly Italian banks. Now, that has somewhat died down a lot since probably when they held their meeting, given some of the moves by the Italian government, capital injection, obviously of 5 billion euros we had into Monte Paschi, helping settle the nerves. And also the minutes stated that several wanted to wait for more confidence on inflation. Certainly the more recent US inflation reading is going to do anything far from give them confidence. So I can kind of understand that play. And one of the other charts I think that's worth looking at is the dollar index. Let me just bring this up. Okay, apologies for a slight delay here. My computer is having an absolute nightmare this morning. Guys, can one of you put a live dollar index chart up, please, in a 1 hour into the... What I was going to show you is basically the dollar index over the last week is essentially what I'm after, because I think that best explains the path of which we've been on and helps interpret the release and information that we had last night. Okay, my browsers are just not working, so essentially we've had a big sell-off in the dollar is what I'm saying. And so when you're trying to understand the reaction to these markets, you had a big sell-off on the back of retail sales. You had those comments out of Williams questioning the methodology used by the Fed and should they be changing the dynamics given low growth and low inflation at the moment. Should they be looking at different types of mandated targets? That caused a big sell-off in the dollar. Then, of course, you had Dudley come out. Now, Dudley is important. We discussed these reasons yesterday because of being usually more dovish, but being extremely hawkish on Tuesday when we had those snap comments shortly after the US CPI reading. And then also because Dudley is the vice chair, so should be representative of the committee as a whole, and also closely aligned with Janet Yellen, so should be a close reading into what the head of the Fed is thinking. Now, although we've just discussed this minutes, which was dated, and we've said it's fairly mixed, and if anything, the market was primed for a hawkish delivery given what Dudley had said, let's just recap again what Dudley specifically did say. Was very clear that September rate hike is possible. We're edging closer, time for a rate hike. US elections will not weigh on Fed decision on rates, and China economy slowing but growth still pretty good. No near-term shock is likely. These are very hawkish from a usually dovish member, and hence we saw a bounce back in the dollar partly yesterday, but in the wake of these minutes we're now back down to around the lows of the week. Now, this puts us at a pretty interesting juncture going forward now, as to look out for a couple of major events which will be forthcoming to look out for in the coming weeks. The next of which will be the end of next week when Janet Yellen has her Jackson Hole speech. Now, for any of the new guys, Jackson Hole has historical importance. It's when she'll talk about the economic environment, so monetary policy, the economy as a whole, and essentially gives her outlook on the state of play and forward looking. So that's going to be key. I've heard a couple of bank guys talking on Bloomberg TV this morning. They're kind of saying, well, if the Fed wants to keep alive their existing dot plot projections of 2 rate hikes in 2016, well then, given the fact that the market is only pricing in around a 40% chance of a rate hike in December, so rate hike's not priced until 2017, then she's going to have to sound hawkish in order to raise expectations of a hike this year. After that, you've then got US non-farm payrolls. That again will be key. Obviously, it's been fairly solid the last 2 months with those high plus 200,000 numbers. That's on the 2nd of September. And then ultimately the big one will be on September 21st, because that's when you get not just the FOMC meeting and decision, you get the summary of economic projections and the presser with Janet Yellen. We'll get an update on the dot plot projections. That'll be key then to don't they raise rates in Sep. That looks very unlikely, particularly in the context of what we had last night. But it will be, do they keep potentially December, or i.e. at least one rate hike this year as a viable option? I certainly think that will probably be their baseline scenario. Okay, so looking forward to today's session, one of the bigger things to look out for in around half an hour's time is going to be UK retail sales. So just showing with you here, last month we had a minus 0.9% reading. And don't forget, this was the June reading. So this was pre-Brexit. Today we're about to see how retail sales fared in the wake of the vote to leave the EU. So last month we had a minus 0.9% reading. That was the biggest fall so far this year and worse than expected. So you've got to ask yourself, with consumer confidence across various different metrics tracking at multi-year lows over the month of July, surely that has to translate then into less spending, so lower retail sales, you would imagine. That's how probably the market will be positioned going into that number. Likelihood looking for a downside figure will probably be the most likely. Therefore, if the market, remember, is priced always on expectation, if everyone's looking for a potential downside surprise and the number comes in strong, that's probably going to work out as a much more bigger move in cable, potentially to the upside. Because don't forget, people are already accustomed to the fact that UK economic data has certainly worsened in the wake of the Brexit. So a solid retail sales number would certainly be a bigger surprise, and ultimately I would say would cause a much larger reaction. Upside in cable, looking at where we trade at the moment, 131 looks like the biggest target, as that's R1 and also just psychologically the handle, and that was where we tested and bounced post the release of the minutes from the FOMC last night. Okay, looking at what else is coming out today. Apart from those retail sales at 9:30 from the UK, you've got the Eurozone CPI readings, but bear in mind these are final July readings. These are unlikely to impact the market. ECB minutes, as I've said a couple of times before, these are the least important of central bank minutes, given the fact that Draghi speaks in a press conference after every decision. So the market is already up to speed with their latest thinking. So the minutes are very dated and unimportant. Later on this afternoon, the regular weekly jobless claims, and then Philly Fed is always interesting. That'll be a key one to watch, again, at 1:30. Now, a very interesting, and I think one of possibly the biggest events of today, is actually not in the form of economic data, it's Fed's Dudley. The guy that kind of rocked the market on Tuesday and shook up Fed expectations by being overtly hawkish is speaking once again. And in the context of the fact that the Fed has been interpreted by the market, at least this morning and last night, as being more dovish than was expected, it will be very interesting to see what Dudley's latest take is here, and whether he kind of readdresses the state of play. Given that the market is now slightly more dovishly positioned, if he comes out and be hawkish again, then certainly we could see some dollar strength off these most depressed levels of where we're trading at the moment. Feds Williams speaking, a non-voter, but that's not until towards the close on Wall Street. Okay guys, gonna finish it with that. So I'll be in the chat room, but enjoy your day. Thank you.